Well, good morning, everybody. We're going to start this second session with Governor Das of the Reserve Bank of India, which needs no introduction. Maybe I need an introduction. I'm Federico Sturzenegger, former governor of the Central Bank of Argentina, currently at the Harvard Kennedy School and Universidad de San Andrés in Buenos Aires. And it's a real privilege to be here with you this morning. The chairs have asked me to give some brief remarks to introduce Governor Das and the issue of monetary policy and emerging economies. And maybe I should start with something which I call the Argentine theorem of inflation. Okay? You know, I'm from Argentina. We know a little bit about inflation in my country. It's currently running at 150%. And what does the Argentine theorem of inflation say? It says that the number of stories for inflation is proportional to the inflation rate. Okay? So that means that the higher the inflation rate, people come up with all kinds of stories as to why there is inflation in the economy. No? So people say, oh, it's the supermarkets, it's used cars, it's the beef producers, it's Putin, it's energy, it's the foreign exchange. So we have all kinds of stories that people build as to why we have inflation. And it's kind of natural that happens, because when you have inflation, lots of things start moving together. So people have a hard time distinguishing what is causing what. And this confusion about the sources of inflation feed into criticisms as to how you run inflation targeting in our economies. You know, our economies have inflation rates which are a little bit higher, somewhat higher than those in developed economies. And so people start saying, no, it's very difficult to implement inflation targeting in emerging economies. And the reasons for that are multiples. People say, oh, the interest rate is not a good channel. You know, the interest rate doesn't have the power to transmit monetary policy, or maybe in emerging economies you're subject to a lot of commodity shocks, and that's going to disrupt the inflation process. Or in emerging economies, the foreign exchange is important, and then it's very difficult to implement inflation targeting if you have an exchange rate which is too volatile. Or maybe food prices are too important into the basket and they're too volatile and subject to international shocks, so it's very difficult to implement inflation targeting in such context. So I think those question marks are here in India, those question marks are in Argentina, those question marks in a lot of the countries like ours, which when you try to do inflation targeting. So actually what I want to do is actually ask myself if it is true that monetary policy works or does not work better or worse than in developed economies when you're doing inflation targeting in countries such as India or Argentina. And in order to do that, I'm going to refer to a work by Martin Uribe. Martin Uribe is a professor of economics at Columbia University. He wrote a paper a few years ago, and he said to understand the role of monetary policy, you need to distinguish between permanent monetary shocks and transitory monetary shocks. So a permanent monetary shock is, for example, a shock which increases the inflation rate in the long run, or maybe reduces the inflation rate in the long run, like you have a stabilization program, you're bringing down inflation, that would be a permanent monetary shock. Like, for example, the US in the 1970s and 80s had a permanent monetary shock that increased inflation, and then it had a permanent monetary shock which decreased inflation. And then you have traditional monetary policy, which is with a given target, then you tighten monetary policy or you lose monetary policy. And the attack of Uribe's paper was that in order to get a good description of monetary policies, you have to distinguish between these two types of shocks: permanent monetary shocks and transitory monetary shocks. And so basically what I've done is I've written a paper where I've extended Uribe's estimations for many countries in the world. He was just looking at the US economy and Japan, so I've done it for many countries in the world. I've also lifted some restrictions, but I don't want to get into the details. I have a slide. I don't know if we can get the slide on, the organizers. I think their wiki is asking for the slide. Yeah, the next one, please. And what I want to do is I want to bring that one exactly. Okay, so what I want to do is show you just this graph, and this graph basically is going to show you how monetary policy works. These are what we would call the transitory monetary shocks, like given a certain inflation target in a tightened monetary policy or a loosened monetary policy. And I want to compare the USA with India, okay, because I had India in my sample, so I think, Governor, you're going to like what you're going to see now, okay? So let me walk you through this slide in just a second. You see on the right-hand side, you have the US. And here what we have is the response, these are the impulse response functions, to a monetary tightening in the US. So the upper right panel is the interest rate. Well, this is basically an increase in the interest rate, which eventually gets tapered off over time. Okay, you see that, it's the interest rate going up. And then you see that that generates a reduction in output, and it generates a reduction in inflation. And in the lower bottom panel of the right column, you see the real interest rate, it increases the real interest rate. So this would be kind of the traditional transmission mechanism that you get from any, say, new Keynesian model of monetary policy. You do a monetary policy tightening, you have a weakening of output, you have a reduction of inflation, okay? So that's the US, that's the US. On the left-hand side, we have India, okay? And if you look at India, you see, first of all, that it's basically the same in terms of how the graphs and the variables move. So if I go to the upper left corner, I have the interest rate, so you see the transitory increase, you have a tightening there where the Reserve Bank of India does a tightening. And then you see on the second graph, it's output, you have a decline in output, you have a decline of inflation. Actually, the decline of inflation is actually bigger than in the US, so we could actually even say that monetary policy is even more effective in India. I mean, the standard errors are a bit big, so I don't want to push it too much, but certainly there's a very distinctive effect of lowering inflation from the tightening of the monetary policy in India, and then, of course, in the lower bottom graph, you see an increase in the interest rate. So you see that the two things are exactly the same, okay? And so I had these results from this paper that I've just written. I thought it was interesting to show it to this audience. And my conclusion is, I don't know, Governor, what is it that you're doing or what the Reserve Bank is doing or your former colleagues have been doing, but you've actually managed to have a central bank where monetary policy is effective. It works very much as in a developed economy, and therefore we all eventually go back to this, that at the end of the day, inflation is a monetary issue, it's solved by the central bank, the tools that central banks have work, and they work effectively to basically to bring it down. So with that, I'm going to pass it over to you, and the session is, we're going to have a presentation by the government of half an hour, and then we'll have a few minutes for Q&A. Okay, thank you.
Professor Federico Stuznegger and members of this distinguished audience. Good morning, and thank you, Professor, for that very quick presentation, which, yes, of course, was somewhat of a music to our ears. But monetary policy is always challenging, and there cannot be any scope for any kind of complacency at any point of time. Now, I'm delighted to be back at this Kautilya Economic Conclave 2023. This is the second edition. I did participate last year also. This event is emerging as a leading forum for well-rounded discourse on economic and other policy issues of contemporary relevance. I'm sure the eminent gathering here will contribute richly to the deliberations during the next 2 or 3 days. Now, in the opening line of my latest monetary policy statement on October 6, I had referred to Kautilya's emphasis on stability in the macroeconomic context. I now propose to share my thoughts on managing the complementarities and the trade-offs associated with price and financial stability. I also propose to touch upon the policy mix to achieve these desirable goals and our experience in India in dealing with these issues. Evidently, the choice of this topic draws inspiration from the nomenclature of this economic conclave, namely the Kautilya economic conclave. But let me first begin by touching upon the current global context. The global economy is now facing a triad of challenges. First, slow moderation in inflation, which is getting interrupted by recurring and overlapping shocks. Second, slowing growth, and that too with fresh and enhanced obstacles. And third, lurking risks of financial stability. Central banks with price stability as their primary objective have raised policy rates aggressively while signaling to keep the rates higher for longer. Some of the central banks have indeed taken a pause on rate hikes also. Financial stability concerns, along with other factors, have conditioned this pursuit following the recent banking sector turmoil in some advanced economies. Financial markets have become highly sensitive to every piece of new information. Policy making has become extraordinarily complex in the middle of such confluence of factors. Increasingly, central bankers face tensions between doing too little or doing too much. While several central banks may prefer the prudence of overkill, somewhat embodied in higher for longer policy stances, financial instability risks rise up to restrain them. With every shock, such as the recent simultaneous surge of crude oil prices, bond yields, and the US dollar, additional dimensions of policy dilemma present themselves and hamstring the responses of the central banks. In such a situation, conflict may arise between the requirements of price and financial stability. But policymakers have to deftly trade a fine balance, as it is important to recognize that price and financial stability reinforce each other in the medium to the long term. Stability is the foundation of sustained progress. As Kautilya explained long ago, and he puts first a question and then he answers it, and I quote, Kautilya first asks, which is preferable, an immediate small gain or a large gain in the future? And then he goes on to answer. He says that a large gain in the future is preferable if it is like a seed yielding fruit in the future. Against this background, let me start with the evolution of the idea of price and financial stability in the global context. The role of central banks had, as all of you would be aware, had evolved by the 19th century as they came to be recognized primarily as the lender of the last resort. Now, this lender of the last resort principle remains the cornerstone of modern central banking, and its scope has widened over time to encompass financial stability. And this financial stability is in respect of, as you would know, markets and financial institutions. Historically, therefore, financial stability has been the core remit of central banks, involving both prevention and management of financial crises. By the second half of the 20th century, inflation surges worldwide caused by post-war fiscal activism and recurring oil price shocks in the backdrop of stagnating economic activity resulted in price stability being recognized as the prime objective of central banks. As inflation targeting gained ground from the early 1990s, a widely accepted view emerged that monetary policy should primarily or perhaps solely focus on price stability, with financial stability falling in the domain of prudential regulation and supervision. price stability was increasingly seen as the best guarantee of financial stability. The extended period of steady growth and low and stable inflation during the so-called Great Moderation era of 1990s and early 2000s lulled central banks into a sense of complacency with regard to regulation and supervision of the financial system. Quietly and in parallel, the seeds of financial instability were germinating. Soon, therefore, the conventional wisdom of price stability being an automatic stabilizer of the financial system got wiped off in favor of the view that price stability on its own would not necessarily safeguard financial stability. This view was further reinforced by the global financial crisis of 2008. Governor Subba Rao in 2012 acknowledged this, stating that, and I quote, "The global financial crisis, followed by the Eurozone debt crisis, has changed the theology of central banking in a fundamental way. The orthodoxy of central banking before the 2008 crisis was single objective, price stability, single instrument, short-term interest rate. The crisis came as a powerful rebuke to central banks for having neglected financial stability in their single-minded pursuit of price stability," unquote. During the global financial crisis, central banks globally undertook large-scale monetary stimulus to depress interest rates to ultra-low levels and rekindle the animal spirits among investors and households. These measures were aimed at restoring financial stability in the near term, but ended up threatening the future of price stability, thus posing an intertemporal trade-off between price and financial stability. In other words, the large-scale monetary and fiscal accommodation undertaken to address financial stability risks during the global financial crisis and in the period thereafter sowed the seeds of inflationary pressures in the subsequent years. In the meantime, central banks had become more proactive on issues of financial stability. Now, central banks again faced a trade-off between price and financial stability during the COVID-19 pandemic as economic activity came to a standstill amidst elevated global commodity prices and disruption of supply chains. As the global financial system became awash with stimulus-injected liquidity, concerns were raised about the implication of the liquidity glut for price stability. With the commencement of the war in Ukraine, these concerns materialized and inflation surged to 40-year high levels. The unprecedented rate hikes which was undertaken by central banks have resulted in large erosion in profitability of some banks in the advanced economies. Obviously, these banks had not adequately factored in the interest rate risks associated with a reversal of the accommodative policy stance pursued by the central banks during the pandemic. The collapse or the failure of some of these banks, particularly in the advanced economies, demonstrated the reverse causality of the trade-off mentioned earlier. In other words, the measures undertaken during the global financial crisis to restore financial stability sowed the seeds of future price instability risks. While this time around, after the pandemic and the war in Ukraine, the measures to address price stability led to concerns relating to financial instability in some parts of the world. Summing up, the last 2 decades have revealed multiple linkages running between financial stability to price stability and vice versa. Measures for promoting financial stability can complement or constrain monetary policy depending upon its usage. And this is very important. Eventually, what matters is the usage of various instruments in the pursuit of financial stability and price stability. Now, financial stability measures aimed at, and I would now like to elaborate. Financial stability measures aimed at effective regulation and supervision of banks, non-banking financial companies, that is like NBFCs, and markets, can enhance monetary transmission and help achieving price stability. Whereas, on the other hand, financial stability measures via extraordinary monetary expansion, if not corrected timely, can jeopardize price stability. Similarly, the linkage from price to financial stability also operates in two ways. First, I talked about financial stability to price stability, and now I am focusing on, on the linkage from price to financial stability, and I would like to see how it operates. Now, it operates in two ways. First, extended period of low and stable inflation could lead to financial instability through complacency loop, as explained earlier. And prolonged periods of depressed growth can keep prices in check, but they could also lead to financial instability. Second, periods of high inflation that are addressed by strong monetary policy tightening can deter financial stability if interest rate risks are not adequately factored in. It is therefore evident that the relationship between price stability and financial stability depends upon the policy choices that we make. Now let me focus on the Indian experience, especially in the recent years. The Reserve Bank, with its assigned responsibility to maintain monetary stability and price stability, also has the larger responsibility of maintaining financial stability, as it is the regulator and supervisor of the banks and other non-financial sector entities like the NBFCs and the like, and also the financial markets. Unlike price stability, financial stability is not specifically defined and it's not explicitly quantifiable. Now, inflation, you can say that the target is 4% or 5% or 2%, whatever. But how do you define financial stability and how do you quantify financial stability is something which is not possible. Particularly the quantification of financial stability, it's not, at least I have not come across any such formulation. Now, as a result, it has been interpreted, that is, financial stability has been interpreted subjectively, specific to context and circumstances. My illustrious predecessor, Governor Y.V. Reddy, defined financial stability in central banking parlance as, and I quote, "Financial stability refers to the smooth functioning of financial markets and institutions. It does not mean absence or avoidance of crisis, but presence of conditions conducive to efficient functioning without serious disruption." I would now like to touch upon the recent years, how the Reserve Bank has managed this trade-off which we face at times, the complementarity between financial and price stability. Now, the unique combination of the Reserve Bank's responsibility of being in charge of monetary policy making and also being the regulator of the financial sector and having macroprudential regulation and microprudential supervision entrusted to it. Now, this combination of functions of the Reserve Bank has enabled the Reserve Bank to focus both on financial and price stability even during the recent years of multiple overlapping and unprecedented shocks coming one after the other. I am referring to the post-ILFS crisis, COVID-19 pandemic, war in Ukraine, unparalleled tightening of interest rates and financial volatilities in that order which we have witnessed in the recent years. Now, following the collapse of the ILFS in the second half of 2018, almost the entire 2019, so far as Reserve Bank is concerned, the entire 2019 necessitated taking measures to intensify the supervision of the NBFCs, close monitoring of their liquidity and stability conditions, infusing system liquidity through innovative instruments like currency buy-sell swaps, which we undertook in March and April 2019, restoring market confidence through appropriate communication, and backing it up with actual action on several fronts. Now, during the entire 2019, the financial markets had almost frozen, liquidity had tightened, and what is more, there was a kind of a crisis of confidence in the financial markets. So the whole of 2019, we were monitoring the activities of the functioning of the non-bank finance companies, that is the NBFCs, both at the aggregate and systemic level, as well as at the level of individual entities. We were monitoring their stability conditions, we were monitoring their asset liability conditions, we were monitoring the liquidity, the inflow, outflow of liquidity. There was a kind of a commitment, in fact, literally, I remember having stuck my neck out when one of the post-monetary policy conferences, press conferences that year, somewhere in June, where, when several questions were asked by the media, and there was a kind of, I could see that there was a crisis of confidence. In fact, I literally stuck my neck out and the neck of the Reserve Bank when I made a commitment that it will be our endeavor to ensure that there is no more failure of a large or a major non-bank finance company. It was a big challenge for our supervision team, for our regulation team in Reserve Bank, but I am happy to share with you that whatever commitment we made, we were able to maintain that, and that was possible because of intensive monitoring, intensive supervision, almost on a weekly basis, and backing it up with actual action in terms of regulatory measures. When COVID-19 pandemic scarred the global economy, now I would like to move on. When COVID-19 pandemic scarred the global economy, including India, our response was swift and decisive. We put in place business continuity measures even before the nationwide lockdown was announced. And the quarantine facility that we set up to run the financial market operations, it's already well known, so I am not elaborating on that. The policy repo rate was reduced sizably by 115 basis points in a span of 2 months, that is between March and May 2020. Unlike advanced economy central banks, which eased rates close to the zero lower bound, we did not reduce the policy repo rate below our inflation target of 4%. Financial conditions were eased substantially by further reducing the reverse repo rate, which lowered the floor rate of the Reserve Bank's liquidity adjustment corridor. This became the effective anchor of money market rates. In addition, liquidity enhancing measures equivalent to 8.7% of GDP were announced. Our liquidity measures were unique in several ways. Liquidity was provided only through Reserve Bank's counterparties, that is banks. Asset purchase program, or the GSAP as was popularly known, was for a limited period of 6 months. Collateral standards were not diluted while offering lending facilities. And most of these liquidity injection measures were targeted and had pre-announced sunset clauses, which helped in their orderly unwinding. In parallel, macroprudential measures like moratorium on repayment of bank and NBFC loans for 6 months, followed by resolution frameworks for COVID-19 stressed assets, were also announced. These resolution frameworks were offered for limited period and were not open-ended, but subject to achievement of certain financial and operational parameters. It may be noted that all these measures which we took during the pandemic and immediately thereafter, it may be noted that all these measures were nuanced, keeping in mind the price and financial stability challenges they may create in the future. Every decision that we took, we were weighing it from the perspective of what risks it will pose to financial stability, what risks it will pose to price stability going forward. And that sort of determined almost all our policy making during that period. Interestingly, the Reserve Bank's balance sheet size, which had expanded to 28.6% of GDP in 2021, that is during the first year of the pandemic, from 24.6% in 2019-20. Let me repeat, The Reserve Bank's balance sheet size, which had expanded to 28.6% of GDP in 2021, from 24.6% in 2019-20, has moderated to about 22.5% of GDP in the last financial year 22-23, going below even its pre-pandemic level. During 2021, the surplus liquidity was gradually migrated from the short end to the longer horizon through variable rate reverse repo auctions of longer tenors, which lifted short-term rates from ultra-low levels, thereby obviating financial stability challenges. This was done by sensitizing the market well in advance through effective communication. The period since the onset of the pandemic was an example of how the Reserve Bank could effectively address macro stability consideration of maintaining price stability through conventional and unconventional monetary policy within the flexibility provided by the flexible inflation targeting framework, while also addressing financial stability considerations simultaneously. The flexibility provided by the dual mandate in our flexible inflation targeting framework, the flexibility provided under this framework of maintaining price stability while keeping in mind the objective of growth, along with the provision of a tolerance band around the target rate of 4%, helped us to accommodate large supply-side shocks while focusing on immediate growth concerns during the pandemic. Subsequently, when the shock of Ukraine war struck in 2022 and there was a sudden surge in inflation, we quickly changed gears by prioritizing inflation over growth and shifting the monetary policy stance from being accommodative to withdrawal of accommodation. Further, given that the nature of inflation process in India was driven largely by supply-side shocks, proactive supply-side measures taken by the government aided to temper the price impulses. Focusing again on the current context, after raising the policy repo rate by 250 basis points cumulatively between May last year and February this year, with the quantum of rate hikes being calibrated in tune with the evolving inflation outlook, we have maintained a pause on policy rates in 23-24 so far. The 250 basis points rate hike is still working through the financial system. We have also appropriately fine-tuned our communication to ensure successful transmission of the interest rate hikes. The prevailing global environment of slowing growth and stubborn inflation, especially in the last few miles before reaching the target. Now, on the one hand, the growth is now slowing down. I'm talking about the global situation. There is a global slowdown of growth, and even the IMF has projected. And the last few miles, almost for every central bank, before the central banks reach their targets, the inflation, it seems to be becoming stubborn. And against this background, economic activity in India exhibits resilience on the back of strong domestic demand. Real GDP growth for 23-24, that is for the current year, is projected at 6.5% by the Reserve Bank, and India is poised to become the new growth engine of the world. We remain extra vigilant on the evolving inflation dynamics. Headline CPI inflation has moderated sharply to 5% in September, with correction in vegetable prices. The outlook on food inflation, however, is beset with uncertainties. On the positive side, core inflation, that is CPI inflation excluding food and fuel, has eased by around 170 basis points to 4.5% from its peak in January 23 this year. We have projected headline CPI inflation at 5.4% for the current financial year. As evident from our survey of September 2023, there is further progress on anchoring of inflation expectations, which entered the single-digit zone for the first time since the COVID-19 pandemic. In the current situation, monetary policy must remain actively disinflationary to ensure that ongoing disinflation process progresses smoothly. On the financial stability front, throughout the multiple shocks in the recent period, the Reserve Bank has adopted a prudent approach and taken several initiatives to revamp regulation and supervision of the banks, the NBFCs, and other financial sector entities by developing an integrated and harmonized architecture. The Indian financial sector has been stable and resilient, as reflected in sustained growth in bank credit backed by improved asset quality, adequate capital and liquidity buffers, and robust earnings growth. Macro stress tests for credit risk reveal that scheduled commercial banks in India would be able to comply with the minimum capital requirements even under severe stress scenarios. The financial indicators of the non-banking financial companies, that is NBFCs, are also in line with that of the broader financial system as per June 2023 data. There is, however, no room for complacency because it is during good times that vulnerabilities may creep in. Hence, buffers are best built up during good times. Banks, NBFCs and other financial sector entities should remain vigilant and complete the pending repairs, if any, to their houses. Roofs need to be fixed, walls need to be further strengthened, and foundations need to be augmented when the weather is good to withstand potential adverse weather events in the future. Let me now conclude. Price stability and financial stability, they complement each other. In fact, price stability is an anchor for financial stability. But the trade-off between the two becomes a close call at times. It has been our endeavor in the Reserve Bank to manage these complementarities and trade-offs as efficiently as possible, while according priority to price stability, keeping in mind the objective of growth as mandated under the law. We treat financial stability as non-negotiable. Our policies and choices of instruments are guided by this holistic approach. We have strengthened our macroeconomic fundamentals and buffers, and these are imparting resilience to the economy to withstand large shocks and navigate in an increasingly turbulent and uncertain global setting. Alan Greenspan, the former Fed chair, once said, I quote, "More fundamentally, an environment of greater economic stability has been key to the impressive growth in much of the world," unquote. India's economic performance in recent years lends credence to this view. Thank you. Namaskar.
Thank you very much, Governor. We have time now for 15-20 minutes for questions, so I'm going to take several from the audience, and maybe we do one or two rounds. And so maybe, Edward, we start with you. I don't know if are there mics? If not, you're going to have to stand up and maybe speak. If we have a mic that we can take, no, okay, so go ahead. Oh, it's coming, great.
Elaboration of how your institution has managed to make significant progress on the dual mandate. And of course, Professor Sturzenegger gave you a compliment in saying that the RBI seems to look like the Fed, although in some circles that may not necessarily be considered a compliment, given that the Fed is not necessarily the paragon of monetary policy making. But two questions about the transmission mechanism. First, Minister Sitharaman spoke about how the digitization of the economy has broadened financial inclusion, brought more people into the banking system. Is it your sense that that increases the effectiveness of monetary policy transmission because you have more people in the banking system? And does it sharpen in any way the trade-offs or complementarities between financial stability and price stability? The second issue is about the current conjuncture of interest rates among the major advanced economy central banks. Now, both you in your role and Governor Sturzenegger, when he managed the Argentinian central bank, are of course subject to external forces as well, and you need to worry about a third objective, exchange rate or capital flow volatility. Is it your sense that the current conjuncture right now is making your life much more complicated in terms of managing the balance between these two objectives, or is it somehow helping you?
We take a few? We take a few? Okay, I think we can take a few questions. Yeah, over here, please, in the front. It's coming, the mic is coming.
One observation and actually a question to you, Federico. The observation is that we had Ellen Ray come through in July, and she presented some of her work on the global financial cycle, which, with careful econometric evidence, she correlated with actions of the Fed. And so the question of how the Reserve Bank should, as it were, respond to risk-on, risk-off issues does arise. Her proposal, for what it was worth, was actually to use macro-pru as the instrument that was targeted to the financial cycle while continuing to use the interest rate for monetary policy and price control. But that's just an observation. I don't know if Governor will want to respond. But Federico is one of the few people in this room who, has worked on Latin America and is interested and is now in India. Let me just ask you at an appropriate time to share doctrine in Latin America amongst Latin American central banks on fiscal monetary coordination. Now, theory does tell us, Mundell Fleming or whatever, that essentially you can choose various configurations of tight fiscal, loose money, tight money, loose fiscal, and those will have real impacts through the real exchange rate channel or whatever. Yet the doctrine is of scrupulous central bank independence. So what are the means by which you end up where you want to on the right fiscal monetary mix in Latin America? Thanks.
And we take one last question over there, and then Governor.
Governor Das, you talked about the resiliency of the Indian banking sector, and we have come a long way since the days of ILFS. One of the trends that we all see in the Indian banking is that the ownership is changing from the government hands to private sector hands. It's been one of those, the debate on privatization and all those things. So fundamentally, as we do that, has the philosophy of regulation changed for RBI? If, in a very specific way, the way we think about the boring and the plumbing side of the banking, like deposit insurance system, the capital regulation, the stress test, and finally the idea of moving away from explicit guarantee that the government-owned banks had to the possibility, expectation of implicit guarantee that the private sector banks might be enjoying. So just wanted to see your thoughts on how the philosophy of regulation is changing as the ownership of asset is moving from government hands to private sector hands. Thank you.
Okay, so we're going to give a few minutes to the Governor to respond to this batch of questions, and I have a few more hands, so we'll do a second round. Governor?
Thank you. Now there are three questions, three sets of questions. I'll take the first and the third one. The second one, I think okay. I would request Professor Federico to take that. Now, so far as digital, it came from Ishwar Prasad. So far as, you referred to digital transactions gaining currency and how it has improved financial inclusion, etc. And you asked whether it facilitates better monetary policy transmission. Yes, that's happening. It's more, digital payments and financial inclusion have actually ensured a greater degree of formalization of the economy. The informal sector in India traditionally has been very large, but the digital payments, the way it has proliferated, the way it has spread in the recent years, and the financial inclusion program, the opening of bank accounts under the various government programs, the Jan Dhan Aadhaar and all that, Jan Dhan Aadhaar mobile and all that facilities which have been given. I think the entire economy is becoming more and more formalized. So in that kind of a setting, policy transmission through the interest rates and deposit rates, interest rates both on bank deposits as well as on bank or non-banking sector credit, the transmission naturally becomes far more effective and quicker. And with regard to the other thing you asked about, I'm sorry, I just missed that. What was the second aspect you asked? Yeah, the current global conjuncture, how difficult it is becoming, for sort of dealing with the various challenges. You see, that is what I was highlighting upon. Of course, the central banks, historically, if you look at almost every present time would look the most challenging. It's not as if we are facing this kind of a crisis for the first time, but yes, as time progresses, the current kind of uncertainty and the complexity which we are facing, geopolitics, financial market volatility, commodity prices, and the supply chain problems, interest rates sort of going up and remaining there at high levels, growth slowing down, inflation coming down, but still, so much away from the targets. Naturally, it makes, life, the policy making much more complex. Now, so far as India is concerned, monetary policy, let me clarify, is determined entirely by domestic factors. We, of course, take into consideration how the external factors are playing out, what impact, let's say, the sudden spurt in commodity prices, how they will impact our domestic inflation, or, for example, the currency exchange rate depreciation, how it is going to lead to imported inflation. All these aspects we consider. We also look at the level at which advanced country currencies are currently prevailing. But after looking at all these aspects, ultimately it is the domestic macroeconomic conditions, the domestic growth scenario, and more importantly in the current context, the domestic inflation outlook is what determines our monetary policy making. Now, so far as the exchange rate is concerned, I have said it openly, we do intervene in the forex market, but we do that only to prevent excessive volatility of the Indian rupee. We have no specific target of the exchange rate in our mind. Our objective is to just ensure that there is no excessive volatility and to facilitate an orderly depreciation or orderly appreciation of the rupee depending on where we stand. And the uncertainties that are confronted, that we confront today, and I think we all thought that the period of uncertainties are over, but I think, as you would have seen in the last fortnight, new uncertainties have been thrown up. So therefore, central banks need to remain very agile, and more than central banks, the first line of defense are the financial institutions and markets themselves. Market infrastructure, those who are custodians of financial market infrastructure, the stock exchanges and various other exchanges, the other regulators, and the financial sector entities, the banks, the NBFCs themselves will have to remain agile and will have to that is what I alluded to when I mentioned that it's in good times that, the seeds of future vulnerabilities are sown. So therefore, banks and financial institutions have to be agile. The third question pertained to philosophy of regulation, whether it is changing. My answer to that is one word, no. The philosophy of banking regulation is to create an environment where the banks are well regulated, they function efficiently, and do not create any potential risk for themselves, or do not create any risk for themselves or for the wider financial sector. Now, our regulations are ownership neutral. All the regulations, excepting, of course, the Bank Nationalization Act, gives certain, places the public sector banks on a slightly different footing with regard to appointment of CEOs, etc. Of course, where the Reserve Bank is consulted. But other than that, our regulation and supervision are ownership neutral. You would have seen that, whether it is the capital requirement or it is the liquidity, the LCR requirement, everything is ownership neutral. Even our supervision is ownership neutral. Even our enforcement action, when we see any deviation from the regulatory guidelines, irrespective of whether it's a public sector bank or a private bank, the action taken by our supervision department and by our enforcement department is neutral. So therefore, we remain, our regulations, supervision, all our actions are ownership neutral.
Thank you, Governor. Let me just take a stab at the question here in the middle. I totally agree that monetary policy has to be focused on the domestic objectives, as you said, Governor. But just a reflection on capital flows and hot money that you just mentioned. I remember something that the president of the Central Bank of Chile, Rodrigo Vergara, used to say is, to the extent that you have a floating exchange rate, a truly floating exchange rate, don't worry about hot money, because it's kind of too dangerous in a truly floating exchange rate. When you start tinkering the market, trying to look, that's when it becomes kind of a one-sided bet for investors, and then things got to get more complicated. And on the coordination of fiscal and monetary policy, I'm going to give you an answer which is very biased by Argentina, my own thought on Argentina, which is this meddling of fiscal policy into central bank policy, and it has led us, as I was saying before, to 50 years of extremely high inflation, 150% inflation right now. So I tend to give a really paramount importance to the independence of the central bank and to kind of detaching monetary policy from fiscal policy. In fact, we have an election on Sunday, and the candidate which is most voted is advocating dollarization. But the reason that he's so popular by advocating dollarization is because he's advocating having an independent central bank. Okay? I want to have an independent central. I don't want to have a central bank, and that means that that's the kind of the strongest way of saying and stating that he wants independence of monetary policy. And then, of course, it's true that if you have loose monetary policy, you're going to have a more appreciated real exchange rate, and that may be a problem or may not be a problem, but I would say that's second order to the fact that you need to have really independent central banks. And I think that has been the big success of Latin America. I mean, Latin America in the last 15, 20 years has established very independent central banks, and have focused on price stability. I think they've been very successful in doing that, and they have not been burdened with the responsibility of kind of undoing whatever mishaps fiscal policy does. And I think that's, as a first order response, I think that's the right approach. Okay, so let's go to the second round of questions. So I have here, in the second table, the gentleman was first. Yes, please. And then the gentleman here, and then.
Thank you. I'm from the Policy Research Institute in Bangladesh. I have a very simple question. From your speech, I understand that Indian inflation was really a combination of demand pull and supply shock factors. So how did you navigate through the trade-offs where, in this kind of a situation, when you have both demand pull and supply shock factors causing your inflation? Thank you.
Thank you very much. The gentleman here in the front. Can you pass on the mic, please?
Thank you. I have a three-part comment and questions. It is.
We're running out of time, so short, please.
Very short. For 20 years, around the world, we had the conclusion, well established, that interest rates would be lower for longer. Now, in the space, we have gone through some shocks, but the world always goes through shocks. We now have the conventional wisdom that it will be higher for longer. So what accounts for the massive structural change in the world economy that accounts for this? Second, why have emerging economies, which were always considered to be more problematic in the control of inflation, have done so much better than the advanced economies in the recent episode? And third, now some leading economists are saying, including the Fed yesterday, Mr. Powell, that maybe monetary policy is not what we thought how it would work, maybe it's not so effective anymore in handling inflation. Thanks.
The lady here, and then we're...
I'll be brief. Thank you, Governor Das, for the very erudite description of how India navigated through the crisis. My question is more for Professor Strauss-Neger. Given that I work on Argentina, what would your advice be for Governor Das? Because this is a country that really puzzles me, how a country can get into such a situation. So what would your advice be to Governor Das for things not to do, even going forward, as Madam Finance Minister spoke about, not burdening the future generations? What not to do to end in a situation like Argentina is?
You never ask an Argentinian on advice on monetary policy, okay? It's very dangerous, okay?
Not on monetary policy, but more generally.
Governor.
Now, the first question was, to the gentleman from Bangladesh. Nice to see you here participating in this conclave. Now, in India, the character of inflation, especially after in the aftermath of the war in Ukraine, I always refer to it, people can disagree, but I refer to the commencement of the unexpected, totally unanticipated war in Ukraine was actually a kind of a break with regard to the, was a kind of a watershed moment, not is in a positive sense, but a watershed moment so far as the inflation trajectory is concerned. Because before the commencement of the war in February last year, we had projected inflation, consumer inflation in India, to be 4.5% average for the current year, that is for the year 22-23, for last year. But the war changed the entire mix of factors, and there was a sudden surge in inflation. Now, the character of inflation in India was different from the inflation in advanced economies in one fundamental way. I think the role of fiscal expansion in inflation in advanced economies was much more than in India. In India, the fiscal expansion during the period of the pandemic to safeguard the economy against the impact of the pandemic, the fiscal expansion in India was very calibrated, focused and targeted. It was not excessive. So, whereas on the other hand, in many advanced economies, the fiscal expansion were hugely excessive. Secondly, it is different in another fundamental way. The liquidity infusion by the central banks between, if you compare India and the advanced economies, as I mentioned during my address, our liquidity expansion were unique. It was unique in several ways. It was targeted. There were end dates which were announced. So there was an automatic unwinding of the liquidity which we infused. And simultaneously, so therefore, the liquidity injection was planned in a manner that we don't see ourselves in a kind of a Chakravyu. Chakravyu is you get caught in that, in that war formation and it's difficult to get out. So these were the fundamental differences so far as India and the advanced economies are concerned. What happened after the outbreak of the war in Ukraine was the huge increase in commodity prices, increase in prices of edible oil, increase in prices of cereals, like for example wheat. We had of course a heat wave last year in the months of April, but along with that, because the international prices of wheat, because the region of war, Russia, Ukraine, that area, a lot of wheat comes to the to the international market from there, and India is a part of the international market. So when the cereal prices, wheat prices went up, Indian wheat prices also went up, despite the fact that we are surplus in wheat production. So therefore, in this context, the question arises, I'm sorry for a slightly long answer, but in this context, what has been the role of monetary policy and what has been the role of the supply side measures? Now, monetary policy acted, the action of the central bank in increasing the interest rates transmitted into the, the lending rates as well as to the deposit rates. The transmission to lending rates, as always, was quicker. Transmission to deposit rates were lagging behind, but now they have, they are now catching up and they have caught up. So the interest rates with regard to bank and non-bank loan credit went up. Liquidity also, there was an auto withdrawal because of the way we had injected liquidity. Automatically it came back. Plus we took several other action, like we increased the cash reserve ratio for the bank. So that automatically squeezed in, sort of impounded lot of liquidity. So liquidity was withdrawn. Interest rates were increased. And I must say that the supply side measures undertaken by the government played a very significant role. In fact, one research paper done by our researchers, it's not the official view of the Reserve Bank, but a research paper done by our research department, economists in the research department, it exactly spells out how many basis point reduction in CPI inflation is due to central bank action, how many basis points reduction is due to supply side measures undertaken by the government. So it was a combination of both. It was basically the nature of the character of inflation in India, the sources of inflation in India, one aspect, and the action that was taken both by the government and the central bank. Now, the question with regard to high for longer, whether we are seeing a new, now, as things stand today, we are saying high for longer. But in the world that we live in today, beyond giving a sort of a generalized kind of forward guidance that we will be very alert, we will be extra vigilant, we will monitor the inflation growth dynamics, hawk's eye or Arjuna's eye, as I have called it on many occasions, on inflation. We will remain alert and we will be very prompt in our response. Beyond that, as it looks, the interest rates are going to be high. But how these economies are going to play out next year in terms of their growth, because if growth slows down, that also creates other challenges for financial stability. So I would not venture to say that, how long these interest rates will be high. But let me make it very clear to my media friends, I am not giving a forward guidance so far as our interest rates are concerned. If you take a cue that Reserve Bank is thinking of reducing interest rates, sorry, there is no such agenda at the moment. Interest rates will remain high. How long they will remain high, I think only time and the way the world is evolving will tell.
Well, we're coming to an end, so let me just finish with 4 thoughts from this talk. Of course, I'm not going to give any advice to Governor Das. I mean, if you look at those impulse response functions that I showed you, if I show them for Argentina, you see nothing. And the reason for that is that for the RBI to look like the Fed, that it takes a lot of time. It takes a lot of credibility. It takes a lot of consistency. I think we saw that here, and so I think we have to learn from that. So the first thing is, I think this trade-off between financial stability and price stability is always going to be there, because you explained that back and forth, correct? And so it's a trade-off we'll have to live with. It's not that we can escape from it. The second point is the complacency that you talked about, I think showed more extremely in the reaction to COVID. Like the reaction to COVID, for example, in the US was pouring a lot of money, which was financed by the government with the Fed buying the government bonds, on people who could not go on the streets to spend. So the only thing that happened is that you had a huge increase in public sector debt and a huge increase in private sector savings, and I don't think that had not much effect, So I think that's kind of a big example of the risk of that complacency that you mentioned. The third thing is that I think it's very interesting that in response to the inflation surge, central banks in emerging economies reacted with less complacency than developed economies. Of course, developed economies were coming from 40 years without inflation. They thought inflation was not coming ever again. But take, for example, the Central Bank of Brazil. The Central Bank of Brazil was the first one to react very forcefully. And why is this? Because inflation for us is a much closer phenomenon. The risks are much higher, so we're much more aware of the risk. I think you described that very well in your talk as well. And so I think both in terms of the COVID reactions, you mentioned that your balance sheet is already below what it was before COVID. That's definitely not the case in the US. And in terms of the reaction to the inflation spike, I think emerging economies kind of have gone ahead of the pack this time, and I think it's because of perhaps our previous failures. And the truth of the matter is that today the US inflation is running at a month-on-month almost 0.5%, so that's kind of way above the inflation target that they have. And my final point is on your thought on this short gain or versus long-term gains, okay? And if you think about the US government bond yields, that's the safe asset. And the reason those yields were so low was because people thought inflation would never come back. Because the biggest risk of a nominal bond, which is 10, 30 years, is the possibility that inflation goes up. And that's gone. I mean, now inflation went up, so certainly those nominal yields on that safe asset are going to remain high for a substantial amount of time. So certainly here there was a short-term gain and a very big long-term loss. So I think that being aware of this, as I think you made it clear in your presentation, I think is very important. So I think we've run out of time, so thank you everybody. And okay, thanks.
Thank you. Great interaction. It was great pleasure. What a pleasure.
What a pleasure.
Yeah, of course.
Thank you to our speakers. Everyone, please bear with me for a few seconds while I guide you. We will move on to our parallel sessions. Tea and coffee will be served in the rooms where the parallel sessions will happen. So if you could all make your way to those halls. The Indian Financial Markets in Transition session is in Jahangir, which is a hall to the left, right up the escalators. Opportunities for Agriculture is in Roshanara Hall, which is on the same floor, close to where you all picked up your badges. And the final parallel, which is China +1 diversification strategy, is in Mumtaz, which is right below the escalator to your left. Again, tea and coffee is in the parallel session halls, so if you could all please make your way to those. Thank you.
Nice meeting you. Yeah, very nice meeting you.